Welcome to Business Success Tips, where you learn to make more money in less time and have a lot more fun. I'm your host, Paul Sanneman, founder of Contractor Staffing Source, where we help contractors build great teams. My guest today is Olga Bashkatova, I got that right, from Next Stage Advisory. So what does Next Stage Advisory do, Olga?
Yeah, thank you. We do accounting for home services companies, but we don't do accounting that you just put away into a drawer for tax purposes once a year, you use it. We do accounting that owners can use to actually run their business in a better way, make more money now, and build up the value of their company so that they have options if they want to sell down the road. Okay. That's what we do.
So do you have what numbers do you think they should have and don't have that you can help support as far as the dashboard goes?
So really, usually they have almost no numbers. So even when we start working with companies, even the ones that are over 5 million and they have an in-house bookkeeper, very often all they have is just cash basis numbers that are it's really the same thing as looking at your bank account statement. And this is why so many owners, they don't really know what accounting is, and they don't even understand, well, what's the point of these financials? They're not giving me anything my bank statement isn't giving me. And it's because your financials shouldn't be mirroring your bank statement. You should be on a full accrual basis. It's just an accounting term, but that is what helps you understand how your expenses tie to your revenues to get your profitability every single month, right? Because the first thing that people should be looking to understand is where they're profitable, which services they provide, which jobs they have, which are profitable and which are not. And the profitability needs to be understood at two levels. Well, the first level is, are we covering the cost of actually providing the service? So the tech salaries, right? For example, the supplies that you're using, any equipment you're using, is that covered? And then how much is left over? That's the gross profit. And then the second item is the net income, which is what you're keeping, right? As the business owner at the end of the day. Was that gross profit enough to cover all of the administrative expenses that the business has? The office manager, the rent, the trucks, the insurance, all of these things, your salary as well, right? Because you as a business owner, you should have, if you have a legitimate business, you should have a salary of some sort. It doesn't have to be high because you are keeping everything that's left over, but it is a cost of business because you most likely, if the business is still smaller, you're still in the business. Then when it's bigger, you're still the CEO, and somebody still has to run the company and draw that salary. And so that is, it sounds really basic, but most companies, even at $8 million level, don't have a good handle on their gross profit or their true net income, on an accrual basis. So which means that they, go ahead.
Don't know me. So for example, I need to know which jobs are making me money, which guys are making me money, which locations are making me money, because it could be the drive out there and back's not worth it. It could be the guy's really slow. It could be that it's a very complicated thing to fix and nobody knows how to fix it. It could be I can't get the parts. There's lots of reasons why it won't work. But I guess unless you know those job by job, you can't say, well, I'm not going to do jobs in this side of town because the traffic is killing us and we're losing money on the commute, or I'm not doing these kind of equipment because I can't get the parts and it's going to take forever, or I got to fire John because he never makes us any money. Are those the kind of decisions you can make?
Yes, that's exactly right. So I have a great story for this. There was a company that we were working with. We start working with them, and they're not sure what's going on. They know that their margins are lower than they should be, but they don't know why. And so it's because overall as a company, they know that something's wrong, but they don't know how to drill down and understand where's the leak. So we broke up their revenues and their expenses by their departments, right? So install versus maintenance versus service. We found that it was the installs that had the super low margins. The other two business lines were okay, versus industry standards. So then we started looking at the techs that are working these jobs, right? So we took a few months and we drilled in just to do an analysis on a few months. And we said, okay, what's going on? Which particular jobs were we losing money on? And so we found that two particular techs on our team were spending a whole lot more time, exactly like you said, on some of the jobs and they were costing them more, and they were costing them a lot of money, thousands and thousands of dollars in costs, right? And kind of lost opportunity on generating more revenue. They should have been able to handle more jobs. So then the business has to decide, okay, the operations team needs to look at this information, right? We give them this sort of this data point, and we say, we can clearly see these two people are performing slower, right? And they're not generating as much revenue and they're not creating that profit margin that we need versus everyone else is. So then the business has to sit down and understand why. It could be that they're just slacking off, right? But it could be, like you mentioned, that these are different types of jobs. Maybe they're the experts. Maybe they get the hardest jobs, right? And that's why they're taking longer. But that means that then the business has to price them higher, because they're obviously not taking into account how much time is being spent by these experts, and maybe their salary's higher also, right, on these jobs. And so the price needs to go up. So this analysis can lead to a lot of takeaways. It starts off like this chain reaction of more analysis that then can lead to good decision making.
Right. So your decisions are only as good as your information, right? I mean, that's for
right.
sure.
That's right.
If you don't have the information, I mean, I think you're right. Most companies go, wow, we didn't make any money this month. I wonder why. They can't say, oh, because there was a traffic jam, because this is hard to install, because Joe's always going to Home Depot and taking too long, or because Martha goes home and takes care of the kid for 3 hours during whatever, right?
Yeah.
So you can't fix it unless you know the problem.
Right.
And what you're telling me is, when you work with a company, you do a sophisticated analysis. You can say where they are losing money and why, and then they can make better decisions.
Yes, we do that as long as we can capture that data, right? So if we know how much time so are there timesheets, right? So we need to have timesheets. We need to know where techs are spending their time to be able to analyze that information. If that information doesn't exist, you can't analyze it. So sometimes step one is saying to a company, we need to know this. You need to put your people on timesheets. They need to start allocating their time to projects so that we can actually know where the cost is going. So that
there's a lot of software that you use it. Literally, there's software you can, on your phone, they'll know where you are, what you're doing, who you're with. I mean, we've gotten really good at tracking stuff, right?
Yes.
So the
software is available. Yes.
And so, but if you're not using it, it's any good. And I remember in the old days, what would happen is the guys would show up on Friday and fill out their timesheets and just guess, right? And it would be paper timesheets.
Yes.
And they go, well, I did about this, and then they just turn on their timesheet. And there's no reality to it at all. It's just what I could remember when I was there. Where today, with the phone, you can literally know where they are, what they're doing, what they're working on, all in real time, right?
That's right. It just, somebody has to enforce that on the ops team. They need to make sure that everybody accounted for their time every day. Their manager, for example, right? Just to make sure that it's happening, because people are people. They do slack off, right? And then another important part there, as they're tracking their time, and this is another thing that you mentioned earlier, is travel time. And so then analyzing travel time and understanding how much time are you spending traveling instead of generating more money, right? So, and then again, that kind of depends on where you're located. If you're in an urban area and it's a large metropolitan city, then you can say, you know what, I'm not going to take calls that are out of like a smaller zone so that I'm not spending all this time in traffic. Right? But if you're in a rural area, you have to take those calls because you just don't have that much demand, right? You don't have that many people there, which means you may need to increase your pricing if your margins are low, right? So it's just something, again, this is data. The decisions that you make will be different depending on your circumstance. But you need the data to know what's wrong and then how to address it.
Well, we've all had guys, for example, where the guy shows up at the job, he needs a doorknob, right? Home Depot is 30 minutes away. So he goes to Home Depot, takes 30 minutes to go there. He has a lunch while he's there because he might as well. So it ends up costing 4 hours of labor to buy a doorknob. So that doorknob ends up costing like $500 for the doorknob, right? And I don't think a lot of times people think about this because, well, I need the doorknob. I didn't have one. Home Depot, and they don't realize the actual cost of driving to Home Depot, driving back. They should have a doorknob in stock on the van because not having one's very expensive.
That's right. And again, so as long as time is being tracked, we can go back, for example, and try to do some of this analysis with the information that that has been captured, and that can lead to these sort of kind of epiphanies, right? Like, oh, we're constantly running to the store for these 5 items, we're always out of them on the truck. Then maybe carry more of them, right? And sometimes it seems so simple, but very often the biggest impact in like the biggest change, right, is something so obvious, right? But it's not obvious until you look at it and see that there's a problem.
Like, obviously, if you do a job at 8 in the morning and it takes you an hour and a half to get there versus doing it at 1 in the afternoon, it takes you 20 minutes. The cost is a different cost in the job, right? So don't schedule any jobs in that part of town at 8 o'clock in the morning because it's going to cost 2 hours to get there. But unless you have that information, you can't make those decisions, right?
Right. Exactly. Yes. Yeah. Great point. So, and then if I can give you another example, and this is not as specific as the one about travel time, for example, or tech costs, but just overall, what I see a lot is, I'm speaking to owners and they say things, oh yeah, we have like 20% profit margins. We've been having like a great year. But they're on a cash basis. And so what they're not taking into account, especially if they're more on the commercial side and they have accounts receivable, for example, outstanding, they're not taking into account maybe cancellations, refunds that are happening later on down the road. They may not be, if they're using any subcontractors who are billing them late, that cost is not being captured. And so it's very rare that people have 20% margins in home services business. Right. You have to be running, either you're very small, so you're like a one-man team, right? And so then, of course, if you work really hard, you can have really high profit margins. But as the company grows, it's difficult to have 20% margins. It means that you're running a really tight, lean ship, and you know exactly what you're doing, and you're going after the right customers, and you're pricing the jobs well, and you're on top of your marketing. But in most cases, what's happening is their accounting is bad. And something is missing. Either their revenue's overstated, their expenses are missing in the period that you're looking at, and really their profit margins aren't 20%. They could be 12%. And that's a huge difference. And for an owner to be that mistaken about their profit margins, it's a really big problem.
I mean, I've seen a lot of times, I'm sure you've seen this happen, Olga, where somebody says, oh, I'm making all this money. And then all of a sudden, January 1st comes around, they go, I owe $40,000 in taxes and I don't have any money. What happened, right? They don't have a clue.
Right, exactly. Right. And that's another thing. So aside from any financial metrics, like any key performance indicators, KPIs, right, as they're called, like average ticket size, right, or closing rate and or gross profit margin, you need to separately be tracking cash. And so you should have a cash forecast. It is extremely important. And this is across any type of business. You need to know how your cash flows in and out versus how you're recognizing revenue and expenses, right? And you need to project that. And especially, there are a lot of one-time sort of annual costs, right? So insurance, for example, maybe you're paying once a year. Taxes, maybe you're paying once a year. I mean, most businesses, they pay them more quarterly, right? But that needs to be, even if it's just quarterly, it's a chunk of money that's just going out the door at a certain period. So you need to have that built into your forecast, right? Or end of year has bonuses being paid out, right? Did you budget for the bonuses, right? Did you remember to make sure that there's money left over?
Projection. A lot of people don't understand that you can only afford to do the business you can finance. Let's say people don't pay you for 30 days or whatever, 60 days, and for whatever reason, then you've got to float the cash. And let's say you're doing, just pick a number, 100,000 a month. You better have 100,000 in cash to float the difference between when you get paid and when you have to pay the bills. And I've worked with a lot of contractors that understand that. And they go, the more business I do, the broker I am. And I go, because you don't figure cash versus accrual. And you have to have the cash to fund the accounts receivable. They don't quite get that idea.
That's right. Yes. Yeah. And because, I think it's because most people don't really, even the business owners, even when they understand the P&L, they don't really know the balance sheet. And so they're not thinking about accounts receivable and accounts payable. They're just thinking, oh, it's revenue, so it's automatically like cash in the door, but it's not. Because if you have a lot of commercial business, you might be seeing that money 60 days down the line, 90 days down the line. You might have to like put somebody on them to follow up so that you can get paid, give them a discount of some sort, perhaps.
Right.
And so that, like you said, you need to be able to float that money. So you can't just grow and take on all this business, even if you can handle it, because financially you might not be able to. So you might need a credit line. Right. Yes.
So
but if you're,
now,
if you're paying, if you're paying for a credit line and you have to pay, a percent, right, for borrowing that money, that should be in your price, right? It needs to be built into that profit margin.
So when you work with people, do you give them this kind of advice? Do you meet with them weekly, monthly? How do you work with a contractor?
So it depends. We have kind of two levels of service. Our main service, that's most popular, we have monthly meetings where we review the financials from the past month, versus, prior year versus prior quarter. And we kind of talk about the findings, what we're seeing, does this make sense for the season? Is this in line? Hopefully we have a budget built out for them as well, so that we can compare it to the budget. Like, this is where we were hoping you would be. This is where you are. And obviously the budget, this is a great time of year actually to build out the budget, right? Because we're at the end of this year. So we should be building budgets for 2026 right now. And so then hopefully you're comparing the financials to the budget, right? And then trying to understand what caused the difference. Did you fall short? Did you exceed, your numbers? If you're exceeding them consistently, your budget, right, then perhaps we need to reforecast. Perhaps we need to, like, throughout the year, just update the budget and make it higher, because obviously you're doing way better. We were too conservative in creating the budget in the first place, and you're doing way better. Did I answer the question? I forgot.
You do them once a month, and you do what other services do you offer than looking at everything once a month?
Right. And sorry, that's right. So the second service level is we do work with them weekly. So the companies that are more focused on growth, maybe they're looking to acquire other companies or looking to grow like super aggressively. Maybe they're entering another market, or they're adding, maybe they're HVAC, but they're adding plumbing or electrical to their business. And they just need constant feedback, right? They need weekly feedback, not monthly feedback. So it's just a higher level of service. And so we work with them to set up some weekly dashboards. And there's more. We usually do job costing for them, for companies that want that level of service. We do kind of like commissions analysis. So commissions for their call center people, right? So who's doing who's generating the most revenue? What's going on with their closing rates, like things like that. For some of the clients, we're also doing their truck cost analysis, and then working with their tax people to figure out more tax efficiency when it comes to their fleet of vehicles.
Right. I mean, the question is, do you buy it, depreciate it? When do you depreciate it? Is it, because I remember a long time ago.
When do you renew them?
And sometimes buying new stuff is cheaper than the old stuff, because the old stuff costs so much to maintain that new stuff is actually cheaper than the old stuff. I mean, it does.
Right. And then with the old stuff, with the new stuff, you get more depreciation.
Right.
And so for tax purposes, there's a lot of planning that can be very beneficial to companies.
Now, how do you charge your service? What's the typical person pay, or does it depend on the client? How do you structure your fees?
Yep. So we have, again, these sort of like ranges depending on what type of service it is. For the main service, our range is typically 6,000 to 9,000 per month. And because these are companies usually over 5 million in revenue, right. And we're taking over their accounting, right. Pretty much all of their accounting operations. Plus, right. We're adding on all this reporting, with KPI scorecards and tracking all these numbers.
Right. And then you have one for smaller companies in that, or is that the main?
We do. So the ones that are more basic, it would be more something like 4,000 to 6,000, which is much cheaper than a full-time person. And certainly we're providing a service at a much higher level than a bookkeeper that is usually hired at, say, 70, 80,000 per year in a company to work full-time. So outsourcing is, in my opinion, of course, it's the right thing to do, especially for smaller companies.
Get more for less, for sure, right?
You're getting more for less, but not when you're hiring one person, you're very limited because you just get their experience, their know-how, right? And so you're not getting the breadth sort of experience when you're hiring a company, and you might have multiple people touching your books, and then of course oversight from experts, right?
Right.
And you're not paying for these experts for full time, but you are getting their input and their oversight on your books.
That makes
sense.
Yeah. So if people want to get in touch with you, Olga, how do they do that?
So people can just give me a call. And so we can provide that information. People can email me. There's also a contact on the website. There's a contact form, and we'll get back to them.
And what if they want to know, well, I'm doing it myself, or I've got this company doing it. Will you help them decide whether it's good to change or not?
Well, the decision obviously is with the owner on whether they want to switch or not, but I'm happy to have conversations with anyone. Also happy to look at their books and kind of let them know what I think, and what things they need to fix, and what kind of enhancements that we can make for them, and then they can make their decision. I think what else really separates us, and this is what I hear from our clients, is that we are more responsive. So we try to, we respond within 24 hours, even though we're not working with the client every day, right? We're more on a weekly cadence and a monthly cadence. But when our clients reach out to us, we respond almost immediately. We're just available. And that is, unfortunately, that's a surprise to most people when it comes to accountants, because they're used to accountants and tax people just being MIA, really difficult to reach. You send them 5 emails before they respond to you, and it's been 3 weeks.
You ask your accountant, should I buy this truck or not? You're sitting at the dealership trying to make a decision. And he says, I'll get back to you in a week, right?
Yes. Although I just have to say, in that case, it is on the owner that they only call their accountant when they're already at the dealership. There should have been more planning. Okay, going on.
You should have called them
the day before they went to
the dealership. I get it. Cool.
Yeah.
Okay.
Yeah. You do need, but you know what? That's happening because the owner is so slammed because they're doing all these other things and they're not on top of their numbers. If they have somebody they could rely on that was giving them good numbers every single month, the whole business would be running in a smoother way, and then they wouldn't be slammed all the time, and they wouldn't be at the dealership calling their tax person before they're about to give a credit card,
Right. Got it. Thanks, Olga. Well, I appreciate being here. This is obviously a big problem for a lot of businesses, and I do agree. I think it's much cheaper to outsource than do it internally lots of times. So appreciate your time. Thank you for being here.
Thank you.